I want to welcome everyone for joining our webinar today. We hope you and your families or colleagues are staying safe and adjusting to this new environment with the second wave and everything going on. It's incredible to think that we're actually 9 months into this whole process since we've had the declaration of a pandemic, global pandemic, and just the whole environment's been so challenging in some ways and has opened up opportunities in a lot of other ways. And I think one of the things that we really see about the pandemic is a lot of asymmetry out there in the marketplace. We had talked about recovery shapes from a V, a U-shaped, an L-shaped, even a W. And I think a lot of what we're seeing is maybe a K-shaped recovery, where some industries are doing very well and other industries are actually being really hard hit. And so that asymmetry that's out there has definitely been seen in the housing market as well. There's certain product or property types, certain locations. Some are doing well, some are more challenged in this environment. And although there's a light at the end of the tunnel, we're certainly not out of the woods yet. With the vaccines coming, we still have a lot of work to do to get there. Today, we have a great speaker who many of you know, Brendan LaCerda of Moody's Analytics, and his presentation will focus on Western Canada, the economy, housing markets. We'll drill into the drivers of the housing supply and demand, including what it means for house prices, provide an overview of what we've seen, and project forward where we're going to see, or what we're going to see in the forecast. Just a little bit of background on the RPS, Moody's Analytics house price forecast, which we believe are the most extensive, comprehensive forecasts available in the marketplace, where RPS brings expertise in valuations, the house price index on the Canadian market, and Moody's brings an extensive international experience and leader in regional economic forecasting. But together, they form a really powerful concept of using house price index or data and forecasting into the future. Certainly that HPI and forecast, we have it in place to support our lenders, mortgage insurers, mortgage professionals, to analyze and understand the risks in the marketplace and help them make smarter decisions. Just a couple of housekeeping items before we dive in. We will be recording this session. We'll share the recording and the presentation deck with you afterwards. Everyone is going to be placed on mute. If you do want to ask questions, and we encourage that, we have the Q&A chat feature open, and we'll get through that and answer any questions that come up during the process. We have about 40 minutes for the presentation, and then at the end, some time for questions and answers. And now for the reason we're here. My pleasure to introduce you to the smartest ex-senior economist from Moody's that I know, and certainly the brains behind all the forecasts. Brendan LaCerda, the Associate Director and Senior Economist at Moody's Analytics. Brendan, I'll leave it to you to take it from here.
Oh, thanks, Joel, and thank you always for your modest introductions. I guess I should start off by saying that this year's webinar is a little bittersweet because I'm doing this from my home rather than in the wonderful city of Vancouver, which I always enjoy visiting so much every year. So there's always next year. So we'll look forward to that. But in the meantime, there's a lot going on in housing, and there's a lot of material I want to cover today. So I'm going to try to move quickly because I want to save a lot of time at the end for questions. So today's presentation, I titled it, is the housing market living on borrowed time, or is this the best time to borrow? It's a little bit of a trick question because it could simultaneously both be true. The housing market could be on borrowed time. It's, prices are about to fall, but if you have no intention on, buying or selling, interest rates are really low. So you can save some money by refinancing. So even if house prices fall, it doesn't make so much difference if you're not planning on moving. Conversely, maybe the housing market's going to fare just fine, but it might not be the right time for you to enter the market because of your own, personal financial situation. So all that aside, I I wanted to start today in a place that you might not have expected. So Laura, if you could jump to the next slide. And I wanted to start today by talking about population growth. So what we're seeing here is the population growth over the last 25 years for a number of different cities, countries, places. If you only remember one thing that I say all day, or if you disagree with everything I'm about to say, I think you can at least walk away with this one interesting fact, which is the cities of Calgary and Edmonton have grown by a larger percentage over the last 25 years than Shanghai, London, the entire world average. Given the size of these cities, the amount of population growth that has occurred in Alberta and British Columbia over the last 25 years is really astounding. Mostly because of the fact, typically if you look at very large, global cities, New York, Berlin, Chicago's of the world, you tend to see, it's the bigger it is to grow, which makes, Calgary, Toronto, Vancouver's growth really all the more astounding. And really what has driven this is, first and foremost is immigration. Canada has one of the advanced countries, Canada has one of the highest immigration rates. That contributes a lot to population growth. For the Calgary and Edmonton area, this time period covers sort of the oil times of the mid 2000s. I should note that since commodity prices crashed around 2015, 2016, population growth in Alberta has slowed significantly. So even though we may not expect these trends to continue, one of the things I think that, I'll sort of start out by putting this out there, but one of the things that Calgary and Edmonton really has going for it is affordability. So, even though the economy has weakened, it's our expectation that because of its, relative attractiveness in terms of price, the demographic trends in Toronto are still pretty strong. I should say that, when we're doing an economic analysis and someone asks me about the long run outlook, the first thing I always look at is the demographics. Population growth can compensate for a lot of sore spots or other ways local. As long as you have a lot of people moving in, that's creating a lot of economic activity. That's the real engine of medium to long run growth. So putting that aside for a second, because we'll population immigration later, the way I want to structure this talk is I first want to address the supply side of the market and then pivot on to the demand side. And once we have those two pieces together, we can get a sense of where the outlook is heading and where the market is headed. Because, the issue here that I'm thinking about is, the economy's been really volatile lately. There's a lot of in the data. So it's really important to think about looking through all that noise. Where is the market equilibrium? So we can do that by trying to get a sense of where's the supply, where's the demand. And then as this noise vanishes, we think, the economy, the housing market will trend towards that equilibrium. So if you jump to the next slide. So the first thing I want to do is lay out what are my rules for forecasting the supply side of the economy. The first one is you need about one person, or you need about one house per one household. So this is not, some profound thing. This is only to say, sort of the obvious intuition that in equilibrium, you're putting about, one family or one group of people per housing unit. If we express that in differences, we can also think about that as you would need one housing start per one new family that moved to the area. Now, of course, there is the caveat to this that, in equilibrium, it's actually going to be slightly better because, houses depreciate, they fall apart, they get knocked down, and people put up new ones in their place. There's a replacement costs, the idea that's sort of related to the idea of, the fixer upper, people buying properties to flip them. And then also, of course, second homeowners, which is a particular consideration in maybe sort of like vacation type markets. That, some people will own two homes. So we're going to have slightly more than one house per household. The second rule here is that housing supply is really inelastic in the short run. And when we say inelastic in economics, we mean the supply is kind of fixed. Or, to put it in other terms, if I gave you $500,000 right now, how long would it take before you could move into a new home? I'm not talking about, units built on speculation. I'm talking about, if you got the money today and you were going to then start the project, how long would it take for, permits, lands, construction, all those things you want? It's going to take some time. And then the third rule I want to talk about is, of course, we all know land is scarce and location is scarcer. So this is always going to factor into the forecast, is that in very, dense metro areas and, in very densely populated cities, it's going to be relatively harder to add new units. Now, that being said, as a country, specifically talking about the West, Canada's population density is quite low. So I'll put up now, this is sort of my, if you want to remember a second thing from today, a fun fact you can share, which is, if you took Columbia, British Columbia has about 5.1 million people. If you wanted to give British Columbia the same population density as Switzerland, you would need to put 195 million people in British Columbia. So what you would have to literally do is you would take the entire Canadian population, you would multiply it by 5, and you would move all those people into British Columbia. And you would have the same population density as Switzerland. Now, I know what you're going to say. Oh, Brendan, this issue's come up before. What about the terrain? What about the weather? The remoteness of, the northern parts of. Okay, point taken there. Let's do the exercise again, but instead about Switzerland, let's talk about Finland. So, Helsinki, the capital of Finland, has about the same latitude as like Fort McMurray, Juneau, Alaska. If you wanted to give British Columbia the same population density as Finland, you would have to multiply the British Columbia population by about 3-fold. So taking 5 million people and making about 15 people. So, I think there's sort of less of an argument about, climate, weather, and all those things there. The point being is that there is a lot of space for the housing market and new people. There's a lot of room to grow. And now, whether that is, sort of natural population growth or whether that comes from immigration, either way. If you want to jump to the next. So going back to the first rule I talked about, where in equilibrium, you want about one house per one new house. So here we're looking at the ratio of housing starts, new houses, to the annual change in households. So basically, you take housing starts, divide it by population growth. And as you can see, what I said before is that, roughly we would expect that this measure should hover or, really just above 1. So if we look at, sort of on the supply side of the market, things generally look like they're in balance, with the exception of Vancouver. There may be a little cause for concern there. The caveat we might want to attach to that is there are a lot of foreign buyers in the Vancouver market. So, they're not counting as residents or households necessarily. expect a number a little higher for Vancouver. Nevertheless, there are some issues of this reduced affordability. We have seen Vancouver's population growth start to slow. So there's a little bit of a balance issue in Vancouver, but generally things look good. I will say though, so what is the concern when, this ratio gets too high? And when we think about that, you focus your attention on the period of 2015, where for, Calgary and Edmonton, we have this elevated ratio. It's up near 2. Now, if we recall history, what happens after this point is the Toronto housing market takes off. Prices soar. In Calgary and Edmonton though, prices weaken. The difference here really is, once again, going back to like population growth. For Toronto, population growth came to the rescue and restored this balance. For Calgary and Edmonton, population growth vanished because the labor market weakened and we had a subsequent fall in prices. So just because this ratio goes high, it doesn't necessarily mean prices are going to fall, but it means that, it's the housing of a tenuous position, and that, the fundamentals of demand need to help restore balance in the market. If you could jump to the next slide. I just want to quickly say, if we look at the same measure, housing starts per population change, if we look at the rest of the West, generally, everything looks like it's in good balance. The relative differences between some of the metro areas really just reflect differences in rates of home building because of prices. So price growth in Kelowna and Victoria is relatively strong right now, along with like Abbotsford. Where on the flip side, Winnipeg, Regina, Saskatoon, prices weaker. So you see builders responding to that with a weaker pace of home building. All right, if you could jump to the next slide. So now we're going to pivot to a discussion of demand. And I think it makes most sense to sort of break things up 2 different ways here, which is there are things, from an economist perspective, there are things that are, we'll say, easier to model. Demographics, population, easier to figure out. Income and wealth, I can figure that out from looking at sort of the relationship of the macroeconomic fundamentals. Leverage, borrowing, modeling interest rates and inflation. The things that are much harder to figure out and have also really come to the forefront with the pandemic. The first one, preferences, which is, what types of property do people prefer? Have people, change their preferences for certain types of properties? We've certainly seen with COVID that people have leaned towards the single family market farther from the urban core and have less favoritism for the downtown high-rise condo. The other part that's, and the hard part about preferences is it's hard to quantify that with data. The number of rooms or, sort of the number of square feet. It's in aggregate, it's very hard to figure out how people's preferences have changed. The next thing, speculation and confidence. This is what, the famous economist John Maynard Keynes referred to this as, the animal spirits of the economy. Kind of the sometimes irrational behavior of consumers. But particularly with, once again, the pandemic, it's clear that, this has taken a hefty toll on, consumer and business confidence. And lastly, the other thing that's really hard to really predict are these policy interventions, which is to say, what exactly is the government how are they going to respond when the crisis hits? Or if we think back a few years, the B20 mortgage stress testing guidelines, what exact form are those going to take? More recently with mortgage deferrals and rental assistance, eviction moratoriums, it's almost like, from an economic modeling perspective, it's like these things, fall from the heavens, and it's in some sense, they sort of come out of nowhere. So, we have to try to tweak and adjust the forecast to try to compensate for how we think these policies are going to affect sales activity or prices. If you could jump to the next slide. So I made it pretty far, but it is the 800-pound gorilla in the room. We do need to talk about the COVID-19 and the pandemic, namely the very troubling rise in the number of new cases. And to put a finer point on that, testing capacity has increased, but if we look at the test positivity rate, we can see that has also risen considerably and is almost near the high point of the early days of the pandemic. And even to put a further finer point on it, it's really the case that the positivity rate in Canada and the United States, they're really not too far off at the moment. Whereas previously you could have said, oh, look back at April. Oh, look back at the summer. Look how worse the US is doing. It's really the case that, if you look at Canada, if you look at the United States, if you look at Europe, everyone's in the same boat here. Everyone is seeing, cases start to skyrocket. And in some sense, the tragedy of this is that it seems like the vaccine, really isn't too far away. And that, if we buckle down and follow the rules and the guidelines, that, we wouldn't have to necessarily go through this. But nevertheless, it's long been our fear that as the winter arrived, you were going to get this second wave. And really, things really started taking off, a little earlier than we expected in September. And the real reason I bring up this picture is it will relate to a later discussion about alternative scenarios. So if we're really, most of this talk, I'll be going through our baseline outlook. But if we want to think about, what does a downside scenario look like? A key element of that would be, an uncontrolled escalation in the number of new cases necessitates severe lockdown. Businesses just can't survive. And you get waves of sort of bankruptcies and layoffs, and the economy falls back into recession. So it's really crucial that, the public health be addressed, because that's a precursor to the economy recovering. And to bring that point home, if we flip to the next slide, and we can look at Google mobility tracking data, so really high frequency data. And we look at, this is visits, so because our phones can track where we go, if we look at visits to retail and recreation establishments, what we can see is this dramatic drop off in March, April, and May. And residential side, the purple line at the top, that's measuring the change in the duration of time people spend at home. So you can see increase in the amount of time people are spending at home, and this huge drop off in the number of visits they're making. If we've really zoomed in closely, what you would see though is that the big regulations from the provinces on closing businesses down, limiting social activity, those really came into effect in late March. But people were already curtailing their economic activity before then. And you can even see sort of as we move to the right-hand side of this picture, visits, economic activity is already starting to fall off in early September, even though a lot of the renewed restrictions didn't even come into place until late September. The bottom line here is that consumers are responding to the news. They're responding to the data that they're learning about the number of cases. And so it doesn't, in some sense, so what I really want to say here in the true sense is there is this, those who claim there's a trade-off between, containing the virus and opening back up. It's a false trade-off, because what this data is telling us is that people are changing their decisions. They're changing their behavior based on the numbers on the pandemic they're seeing. They're not waiting for politicians or public health officials to tell them what to do. So, in terms of, how do we get back to a recovery? First, addressing the public health issue, addressing the pandemic. And then once that is taken care of, then the true recovery can get underway. Will you jump to the next slide? So as Joel alluded to in the introduction, one of the big things I wanted to focus on, because this also relates to the housing market, is the extreme amount of asymmetry that the pandemic has generated. And what I mean by that is the impact that the pandemic has had on employment in different industries. So what we're looking at here in this chart, on the x-axis, so the horizontal, that is the peak to trough decline in employment, which is basically where were you in January at the start of the year versus where were you in like April, May, when the economy was at its low point. So what's your peak to trough decline? On the y-axis, the vertical, what we're looking at is the previous peak versus where that industry is today. So sort of a measure of, more a measure of like recovery, sort of like a before and after comparison. And what we can see here is really three distinct clusters of industries. On the top right, the green circle, employment in these industries is up since the start of the year. Utilities, finance, insurance, real estate, professional services, technical, scientific, education. If you look at these industries, you wouldn't even know that a pandemic was going on. The middle cluster here in the black circle, these industries got hit hard, but now they're basically back to where they were before. Trade, manufacturing, healthcare, oil and gas, public administration. They're basically flat year over year. The trouble spot is these industries in red, which is transportation and warehousing. So it's clear, because of the drop off in demand for transportation, that industry has been hit hard and it hasn't recovered very much. The other two I want to note here, building business and other support services, and actually construction is in this red group. This really speaks to the weakness in the non-residential market, not the residential market, which is, everyone's working from home, or really, if you look at the data, about 25–30% of people are working from home. Demand for office space, demand for retail space has really fallen off. So that's why you see, these continued large layoffs in these industries. The other one other interesting one, information, culture, and recreation, ICR. There's really two different things going on there. On the information side, software is doing really well. But on the culture and recreation side, you think about sort of tourism type stuff, that's really hurting. Which is made obvious by, if you look way out on the left, food services and accommodation laid off about 50% of people at the worst point of the crisis. And even still today, employment is down about 20%. So that's, that industry is sort of, it's like the Pluto of the solar system. It's just, orbiting way out there. It's in a league of its own about, how bad conditions are in that industry. And the issue here is that you have to, as we think sort of about house prices and housing market and how that relates to, the labor market, metros that have a larger share of their economy devoted to these hard-hit industries, we would expect them to do worse. If you could jump to the next slide. Another sort of really key thing we want to focus on in terms of the asymmetry here is employment by weekly earnings. So we're looking at employment by income. Now these are weekly earnings. So if you wanted to get, annual earnings, you can sort of roughly like multiply things by 50. So the blue line would be, individuals making less than 25,000 a year. The green line would be 25,000 to 40,000. The red line here, 40,000 to 60,000. And the highest group, the gray line, 60,000, about 60,000 or more a year. The median salary is about $1,100 a week. So the median person is in that red group. So what do we see here is this huge divergence in the performance of employment depending on salary level. For the highest income earners, the gray line, over 60,000 a year, barely a blip. Now there's a little drop in Q1, and we've continued growing since. These are tying this back to the housing market. If we think about, why has the housing market continued to do so well despite, everything that's gone on? It's because your typical home buyer, who's a high income earner, still has their job. And in fact, the number of those high income jobs has grown. Explains why, income is so tied to house prices. These people's income is held up just fine. For middle class, the red line, we could say, yeah, they were hit hard. We can see a sizable amount of job loss there, but they are back to where they were before. What we see really here, though, is with the green and the blue lines, the low income earners, employment is still significantly depressed, and the pace of the recovery is weakening. To this point, I would, looking at this data, I would say, for the owner-occupied market, things look good. On the rental side, there's definitely cause for concern because the people in the blue and the green group are renters. And as it stands right now, they're getting rental assistance, maybe, eviction moratoriums. There's real questions about how well the rental market's going to perform once those supports are removed. If you could flip to the next slide. Continuing with the idea of asymmetry, continuing with the idea of the labor market, looking at taking all the layoffs that have occurred and breaking them out by whether or not they're permanent or temporary also reveals a very troubling picture. What we can see is that with the big job gains numbers we've seen over the last few months, a lot of those are coming from people who were temporarily laid off and they've come back to work. What really concerns me looking at this picture is that significantly elevated level of permanent layoffs, because people who have been permanently laid off, it's a much longer process to get them back to employed. And we can see, yeah, there was initially a sharp recovery, but that's slowing down. So if you jump to the next slide, looking at, what's our forecast going ahead? Well, unemployment peaks, it quickly recovers, but going ahead into 2021, the progress for, the recovery is going to slow. Now, we talk here about sort of the 4 stages of the business cycle. We've already been through the recession, the reopening's already happened. Right now, we're in this limbo period. Job growth, GDP growth, it's going to slow through the winter, through the fourth quarter and through the first quarter because of these rising number of COVID cases as the economy sort of pulls back again. But really, once that vaccine comes online, which we expect in probably like the second quarter, like mid-2021, Once that becomes available, we expect a much stronger recovery to get underway. It's a little hard to decipher from this picture because the magnitudes of the changes are so massive. But believe me when I say that we're going through this slow patch right now, but we expect things will really start to pick up in mid-2021. Now, can you jump to the next slide? So I want to pause here and say, unemployment has soared, but the housing market has done just fine. I want to make clear that this is a weird anomaly that has resulted only really because the pandemic has had this lopsided effect on low-income earners, whereas high-income earners are fine. I want to say, though, going forward, unemployment, the labor market, and the housing market are still connected. In a typical recession, you don't have this weird lopsided effect. Job losses tend to be pretty spread out across income groups. So we shouldn't change our understanding of the housing market and the labor market just because of recent events. But let's focus in on what happened during COVID. So what I'm doing here is we're showing a scatter plot. On the x-axis, we have the year-over-year change in house prices for each of these metro areas. And on the vertical axis, I have the year-over-year change in the unemployment rate in percentage point terms. What this chart shows, because if you see the trend line there, the line of best fit, what this trend line means is that the bigger the increase in unemployment, the bigger the increase in house prices were. I'll pause there because we need to sort of take that in for a moment. This is, if you think about that completely contradicts your economic intuition. The more people lost their jobs, the better the housing market did in that area. It really doesn't make a ton of sense. But as I said before, the labor market and housing is disconnected. And, one of the things I'd point out on this picture here is we look at Edmonton, Calgary, Montreal, Vancouver, Toronto, the biggest metros in Canada. Each one of them, unemployment increase, if we look at sort of the vertical, they're all sort of on the same, horizontal line. Unemployment in the biggest cities in Canada pretty much increased by the same amount in all the biggest cities. However, the left to right difference, the housing market, in Edmonton, house prices are down year over year. Calgary, barely positive. In Vancouver, house prices are up 12% year over year. What explains this huge difference? And if we take this picture here and we sort of cut it down the middle, on one side, we'll put Edmonton, Calgary, Saskatchewan, Saskatoon, Regina. And then on the other side, we'll put, Vancouver, Toronto, Victoria, and then the sort of the hottest housing market in Canada at the moment, OHL, which is Ottawa. So if we have Ottawa, Vancouver, Toronto, Victoria on one side, and then some of these other Western metros on the other side, what really makes the difference between these two areas? If you could jump to the next slide. Voila, what do we get? What are the poor performing metros on the left side? Edmonton, Calgary, Regina, Saskatoon, Winnipeg. Who are those hot housing markets? Ottawa, Victoria, Toronto, Vancouver. What we're looking at here is the active deferral rate on CMHC insured mortgages. So this isn't the entire universe of mortgages, but this is the active deferral rate on the CMC, and the one CMHC is insuring. And what we see is way higher in the Western metros. The people who took advantage of the mortgage deferral option that was created during the COVID pandemic, there's a much higher take-up rate in the West than those other metro provinces. So what I want to sort of the takeaway here is we can, in some sense, we can rethink about the pandemic. Think about the pandemic as a mortgage stress test. If I take the economy offline and, we shut down businesses and people can't work, we take away their income, who's the most in trouble? Well, it would be if there was a higher, active deferral rate, those would be the metros where the health of households' balance sheets is not as strong. And this is really going to factor into the forecast when we look ahead. So if we jump to the next slide, what we want to think about is going ahead. If we take a step, if we go back in time to 2018, we'll remember that, the story, what we were all talking about, what we were all worried about is, Canadian household debt. We're all talking about debt to income ratio, all these things. Now, in some ways you can think about, the pandemic came along and our attention has been directed elsewhere now. But the point I want to try to make is we weren't wrong, that our intuition was correct, that, household debt was and still is this really big issue. That, what we see on the previous page was that, depending on the balance sheet health of households in different metros, that's what determined how those housing markets are doing, not the labor market. So as I look ahead and I want to think about, where are house prices headed, the first thing I want to think about is, where is leverage headed? Where is debt headed? And there's two inflection points we need to think about going ahead. The first one is, when is the Bank of Canada going to end quantitative easing, or really taper quantitative easing? And when are they going to start raising the overnight rate? Well, it's our expectation that, in mid-2021, when the vaccine becomes available and when the economy starts heating up, that's when quantitative easing is going to end. And once the Bank of Canada stops buying all these assets, interest rates are going up. Interest rates are going to pivot in 2021. Now, the Bank of Canada doesn't raise the policy rate till 2023, and that's going to continue to lift interest rates farther out. But the thing I want to focus on here is 2021. Because if we jump to the next slide, our expectation right now is that as interest rates start to rise, a lot of those, previously, if you think about it, a lot of those a lot of those people that were on the margin, I can almost afford a home, or I can almost afford a bigger home. When interest rates dropped, those people became eligible to, buy the property they want. The purchase, was suddenly, came within their striking distance. The problem is, as interest rates start to creep up in 2021, the pool of potential buyers is going to start to shrink. That's point number one. So you're losing some demand. The other thing is, as interest rates start to creep up, some folks are going to run into, credit problems. That's going to, cause them to need to deleverage. So that's going to put some downward pressure on home prices. And then you're also all the, government's fiscal support programs, income support programs, expanded unemployment benefits. Those are going to start to wind down and fade in mid-2021 once that vaccine comes online. So, some people are also going to be losing that income support. So you can think about all the things that drove house prices up during the pandemic are now going to reverse, and we're expecting that prices will also reverse slightly. Now, I should say the drop isn't, we're talking about maybe 5-6 percentage points. It's not enough to, cross, homeowners' equity thresholds or anything of that sort. And it's fairly brief, and we expect prices to really start to pick up again in 2022 when a much healthier labor market takes hold. Now, if you could, we also do upside and downside scenarios for prices. And one thing I should say is, what's behind this downside scenario? Well, it really is, a much larger surge in COVID cases, requires a much more severe lockdown that pushes businesses over the brink and into bankruptcy, which leads to layoffs. And once you have all these bankruptcies and layoffs, credit delinquencies, loan performance become a real problem, and you get a little bit of a credit crisis in financial markets. So those are the, huge surge in COVID and a bit of a credit crisis. Those are the elements you would need to get to that, downside scenario. If you could jump to the next slide. So I want to just hone in on the West market for a second here, and talking about these issues where, we know the quality of credit is a little weaker in the West. The West is also much closely tied to commodity prices, global trade, transportation, logistics industries. So because of these unique factors or structures in the Western economies, what we see here is if we look at some of the Western markets like Saskatoon, Regina, Calgary, Edmonton, if we look at the green bars, which is the price change for 2021, what we expect is that the price declines in these Western markets will be a little more severe. On the flip side, though, because these markets are much more affordable, when the real recovery takes hold in 2022, there's going to be much larger price increases in these same markets. So if we had to say, what's the difference between the West and the rest of the country, there's going to be much more of this roller coaster in prices. Worse in 2021, but much stronger in 2022. And construction activity would probably follow these same exact patterns because builders are taking their cues from prices. And if we flip to the last slide, I just want to add sort of one more point. Nothing too profound here, just to say, if we look at the price differences between different types of property units, it should probably come as very little surprise that the blue line and the red line, the single family detached market in British Columbia and Alberta, is going to perform much better. By that you can see much larger price increases over the next few years. Whereas on the multifamily, apartment condo side, for British Columbia, we expect things to be, almost completely flat. And that's an issue of affordability, just because prices have increased so much over the last few years. The multifamily market in Alberta, probably going to, we'll see some appreciation there, just because once again, affordability is so much more attractive in those markets than elsewhere. So I'll pause there. That's the end of my prepared remarks. And I'd like to open it up now for questions. So it looks like we're still doing pretty good on time here. And I want to save a little time for Joel at the end. But we can cover some of the questions now.
Just while we're getting there and any questions that might come up, I certainly do want to confirm I'd rather live in Canada and certainly Western Canada more so than either Sweden or Finland. So that would be a certainly positive thing there. Certainly, I think lots of positive things are coming with the potential cures and other aspects of working on COVID-19 and the lockdowns, getting out of those and behaving properly through that certainly bodes well for the market after 2021, if as Brendan has pointed out. So I don't know if we've had any questions in the Q&A yet.
All right, I think I see we got one question coming in. Is the surge in single-family housing demand is it sort of temporary due to COVID, and post-COVID demand will shift back to multifamily? As the sort of the point I want to make here is, how do we actually put a number on like the magnitude of the shift from like multifamily to single family? If I look at I can look at the construction data, I can see multifamily and single family construction. There hasn't really been, in terms of housing starts, you really don't see this like huge shift in, people changing their preferences. I will say this, if we go back to the beginning of my discussion, when I talked about the supply of the housing market is very inelastic, it's very fixed. If the supply in the market is fixed, you have to think that you would really only need a small change in demand to cause potentially big changes in prices. Now, I think, the other point I want to make is in terms of thinking about this change in preferences from single family to multifamily. It's hard to separate that from the decline in interest rates. Which is to say, suppose I was living in a multifamily unit, a condo apartment. The drop in interest rates maybe pushed me over the edge and made that single family unit, within my, price range. I could finally afford it. So I'm inclined to believe that a lot of this movement between property prices or property types is actually being driven by, sort of credit availability. And what you also want to see, if you look back at my interest rate forecast, what you see is that, interest rates are, record low right now, and they're going to pivot up. And I think that a lot of potential home buyers are incorporating this expectation. They're thinking, this is the lowest interest rates are, going to be for a while, and that, borrowing is going to get more expensive in like the years ahead. So I'm going to pull the trigger now and buy that single family home, I've had my eye on. And so, going ahead, there's still always going to be the preference for single family over like multifamily. I think if the vaccine is effective, then the normal, buying patterns of single family versus multifamily are, going to go back into place. The alternative scenario, though, is if, COVID doesn't really go away, if the virus mutated and it just sort of comes back, every single year, maybe in a milder form, then you would have a more permanent shift in preferences. So sort of, we have to do a little bit of wait and see. And I see we had a sort of another question come in. What is the biggest risk to the Western housing market in 2021? I think it's made really clear by that mortgage active deferral chart, which is to say that we can see in the Western market that a lot more people are taking use of the deferrals. The labor market is generally slightly weaker in Canada. So my concern would be that if the mortgage deferrals run out and the government stimulus runs out, the housing market in the West appears less able to stand on its own 2 feet versus the housing market in the East. If we add into that a potential, what we would call a taper tantrum. So if we go back to the last recession, when the United States government, or when the Federal Reserve tried to end quantitative easing, financial markets panicked and interest rates spiked. So one of the things I'm very worried about going into 2021 is how are financial markets going to react when the government and the central bank withdraws that support? Because it didn't go well last time. And if interest rates spike and hiring sputters, then the West appears to be more exposed to these issues of debt and leverage.
Okay. Sorry.
I'll pause there. I think we'll have to end it there. It has been really great. I'll turn it back over to Joel.
Okay. I want to say a huge thank you to Brendan. I can say you always provide interesting insights into the economy and the housing market. Much appreciated for you sharing them with us today. Again, a thank you to our audience for joining us, participating in the session, and the insightful questions. Just in terms of housekeeping, we will be giving you a short survey right at the end of this, and we will be sharing the recording and the presentation deck with you very shortly. If there's anything at all that either RPS or Moody's Analytics team can share with you or help with you, please reach out. We're there for you as trusted partners, and we're working hard on that side. The holidays are certainly almost upon us, and we certainly hope that your families have a safe and healthy holiday season and enjoy what's ahead of us for a quick break before we get right back to early January and the beginning of a new year. So thank you very much for joining us. Thank you, Brendan. Goodbye now.